Investors have abandoned relatively safe government bonds around the globe as riskier assets stabilise from the recent carnage. Well, the moves have generated the biggest one-day sell-off in US Treasury bonds in more than 2 years. However, this hasn't caused yields to fluctuate as much as some might expect. Billy Bambrough has been speaking to the experts to find out why.
Despite US Treasury yields jumping to their highest level in a week, with the 10-year posting its largest one-day yield gain in 2 years after falling for 4 straight days, this move underwhelmed some investors. Frank Investments' Paul Sedgwick thinks that there are 2 reasons for the smaller-than-expected moves in the US.
I think there are 2 things here. One is if you look at the equity market, the fact of the matter is that equity valuations got stretched across the market. So now a lot of the concerns that the reasons that the equity market had come off is because they're on global growth concerns. That seems to be the premise for the fall in equity markets, because worried about China, the implications for the rest of the world. Now, if there were real concerns about the global economy, that should, in theory, be reflected in the bond market, in my view. If you saw in 2011, when people were very concerned about what was happening with the US economy, bonds rallied sharply. Whenever you have generally economic concerns about growth, you tend to see a rally in the bond market. Now, US Treasuries, over this period of volatility in equities, has hardly moved. I mean, yields have fallen, to be fair. I mean, at the peak, they were around 240. But in the last month or so, when we've had this volatility in equity markets, they haven't really dropped quite a great deal and are still pretty much where they were at the start of the year.
Paul is surprised that China government bonds have also remained flat.
If you look at Chinese 10-year bonds, they're pretty much, yields have fallen, but again, they're sort of roughly where they have been for a while now. So it just struck me that it was interesting that even though there were a lot of global growth concerns out there, that actually bond markets in general had stayed pretty much where they were. And a lot of concerns that you may have seen, you see a flight to quality, you see a flight to bonds. On this occasion, there may have been some, and a lot of money has still gone into the bond market again this year, but there hasn't been possibly the aggressive movements in the bond market that you might expect to see when you see such a big sell-off in equities.
Wealth manager Jonathan Davis thinks that government bonds have been a safe haven for some time.
I've been a very strong bull on government bonds for months, and indeed for the last couple of years, whilst it appears the rest of the world has been hugely bearish on government bonds. Every other article or radio television piece has been saying rates and yields are going to soar. Well, like the unicorn, I'll believe it when I see it. What's been very interesting is that up to the point that stock markets were falling sharply, bonds were doing particularly well. But while the stock markets were falling, particularly the last 2 or 3 days, actually bonds have taken a pause. And we would have expected on Monday, when we had the avalanche of stock prices, we would normally have expected bond prices to have soared, but in fact they were flat.
Some think that we may see government bonds in the US take a hit if the Federal Reserve raises interest rates. Jonathan, however, doesn't think this is a very likely scenario.
I'll believe it when I see it. I've been saying for the last 3 years that hell will freeze over before we see central banks, as in the Fed, the Bank of England, the Bank of Japan, the ECB, etc., raise interest rates. I'll be very, very surprised if that happens in the foreseeable future. If it happens, then yes, we would expect there to be a sharp sell-off in government bonds. Take the last couple of years. It seems that every other week or certainly every month, we've seen central bankers, we've seen highfalutin economists, we've seen big bankers come out and say interest rates are going to rise. And then people like me say, I don't see it. I can't see why it happened, not with all the amount of debt that's around. And in any case, the market is simply not accepting that interest rates are going to rise because bond prices continue to trend up. And sure enough, there was apparently going to be a certainty that interest rates were going to rise last December in America. They didn't. Oh, then it was going to be March. Didn't happen. Then it was going to be June. And of course, as you well know, it was absolutely, definitely going to be next month. Well, isn't it funny? The market expectation for September hike has absolutely been demolished. So now they're pushing it back to 2016. Well, again, I suspect we'll see a unicorn before we see an interest rate rise.
Frank Investments' Paul Sedgwick thinks that if we do see an interest rate rise, it will have only a minor effect.
My personal view is if we do see a change in interest rate policy in either the US or the UK, I mean, obviously September's when everybody was expecting the US and possibly the start of the year in 2016 for the UK. My personal view is that the markets anticipated this, possibly discounted it to a degree, but the move is going to be pretty modest in the overall scheme of things. I mean, we're probably talking about 0.25%. So I would think that my personal view is that you never know, it could trigger another sell-off. In a way, one could almost argue that if they did put them up, it would be a signal that the Federal Reserve in the US actually feel the underlying economic growth in the US is a little bit more robust than people think. It may even send a positive signal out to the markets. I mean, in a way, if I don't know whether what would be the reaction. Supposing the Fed came out and said we're going to announce QE4. I mean, some people would argue, well, QE1, 2, and 3 hasn't worked. Why should QE4? Maybe it would lead to an actual sell-off in risk assets. Markets don't always work in the way that people naturally assume that they would. And so maybe an interest rate rise would send a signal to the markets that actually the Fed believes that the US economy is on a slightly firmer footing than people believe. And remember that historically, rising rates are supposed to be a positive for risk assets because it's supposed to suggest that economic growth is picking up. So it's very hard to know how markets are going to react to any piece of news, I think.